Hey guys, it's Miguel from Big Bear eXp Realty. I have the branch office up here in Big Bear on Moonridge Road. And if you'd seen my video before, we're going to start doing little segments, not just on real estate, but on Big Bear Lake itself. Today we're here with All American Financial Services, and we're going to be talking about different situations. So Dante and Dillon, one of the big misconceptions I see up here in Big Bear is they think they can't afford a house because they don't have the down payment. So what exactly do they really need?
That is a common misconception. So everyone in the home purchasing industry believes they need 20% down to get a home. And that's not true. We can go as low as 3% on conventional and 3.5% on an FHA loan. We also have great down payment assistance programs to help even with that 3 and 3.5%. So 20%, just a legend or a myth.
Dillon, what about the FICO scores? Everyone thinks they need an incredible FICO score.
So a FICO score is going to vary on the loan type. So if you're looking at an FHA loan, we can also go down to 500 FICO. That's something that you can actually qualify for as low as 500, but you can get as low as 620 for most programs out there as far as investment property or second home as well. So it's just going to depend on the program, but you don't necessarily need that 740 FICO that most people will think that they need.
Wow, that's actually something that I also thought that you had to have a much better FICO score than that. So that's good to know for a lot of people up here who maybe are just starting out.
Yep.
Okay.
And if you do fall underneath those credit thresholds, we do have credit repair help available. So if you are struggling with the credit, don't know how to bounce back from it, we're a great place to start.
Good to know.
Yeah.
One of the things that's confusing on paper, and let's be honest, most of the time nowadays people want to see things on a video or told to them, is debt to income ratio. What exactly does that mean?
That is one of our most frequently asked questions. So debt to income, the most simple way to explain it is money coming in versus money going out. So a good example is if you make $10,000 a month and you have about $2,000 in debts. So you're at about a 20% debt to income ratio. It's a very common used practice in lending, and it will be one of the factors we look at when seeing if you are approved for a loan.
What would be considered a threshold to make it a bad debt to income?
So over 50% is definitely a red flag. We generally like to stay under 43%. Again, we'll fight for every dollar, every penny, but generally under 43%. 20% is a fantastic DTI. We don't see that very often.
And also something to add to this, there are other programs that you can qualify for if your debt to income is higher. Now things may change, you may have to have a higher down payment, or we can go into a bank statement program. You have DSCR programs. So if debt to income is an issue, there are other programs to help you get the property still.
One of the questions I get asked a lot is, I'm not an American citizen. Can I buy a house? And I myself have also heard of something called I-10.
Yeah.
Can you explain those two?
Yeah, so with an I-10 program, that's for a client who's they don't have a social security number. So basically what they use is their identification number, which is what they use to file their taxes. They do have programs for you as well. The programs are a minimum of 15% down, but you can still qualify if you do have that identification through the I-10 number opposed to the social security card. So that is a good option for them. Also, you have private money options, which you can also qualify for. So there definitely are programs out there if you do have an I-10 number and not a social security card.
A lot of things that, again, come up in brochures and so on, which make it very confusing to people, and they really want to get a better explanation of it, as do I. What exactly is loan to value?
That is a great question, and again, one of our frequently asked questions. So loan to value in simple terms is how much loan are you taking out compared to the value of the home. So let's say, again, we'll use a nice flat number like $1 million. So we're using $1 million, we're taking out a $200,000 loan. That's a 20% loan to value. Again, that's one of the indicators that we use, and it determines your interest rate. A lot of it's determined by your down payment. So a lot of factors go into determining LTV. It does help you get a better interest rate.
Well, when I get my 20% on that million, I'll call you guys.
Yeah.
Now let's talk about interest rates. What are the key factors in qualifying and getting the best interest rates out there?
That's a great question. A lot of people have concerns about why their interest rate may be higher or why people are getting lower interest rates. So the three things that we look at your credit score, we look at your loan to value, which we just spoke about, and then we also look at the occupancy of the property, whether it's an investment property, a primary residence, a second home. Those are going to be your key factors when it comes to figuring out what your interest rate's going to be.
Now, Dante and Dillon, direct question for you guys. You've been coming up here for quite a while now.
Yep.
and seem very interested in working with us, the community in general. What sets you apart? What sets All American Financial apart from the rest?
I would say the first thing that sets us apart is we work 7 days a week. So we are not the typical banker. Our phones stay on Saturday and Sunday, and we're willing to go above and beyond for our clients, whether that's driving to homes to collect paperwork, really identifying what's the best program for them, and also the plethora of programs we have available. So a lot of people don't know that we can help the people who have been turned down by traditional banks, traditional lenders. We can work with the FICOs even under 500 in certain circumstances. We can help with people whose homes aren't even finished being built yet. So we have such an umbrella in which we can help that I think that sets us apart.
And also as us being brokers, we actually work with multiple lenders in order to shop for you, the consumer, which is a big thing. If you go to the bank, they have their rates. But for us, we have multiple lenders that we work with, so we can shop for you on the day that we're actually trying to lock your rate in order to make sure that we're getting you the best interest rate. So we do the shopping for you to make your life easier.
Well, I got to say that if you treat all your clients the way you have been treating us, as in answering our phone calls, being right there when we needed a question answered, I can't wait for them to try you guys out because I think they're going to be in great hands.
No, we appreciate it. Thank you.
Yeah.